Good morning, Uma.
Oh, hi, morning.
How are you?
Madhu.
Yogita.
Oh, hi, Yogita. How are you?
I'm good. I'm good.
Everything is, my voice is carrying okay?
Yeah, fantastic. So, should we share the presentation or will you be sharing
Now,
from
I
your end?
will share it because I'll have to move it, right? I would
Yes,
prefer
yes,
that I
yes.
push it myself.
Right. So once I'll just briefly introduce you and then you can carry on and then I can quickly talk about certifications.
Sure. Now, what I wanted to ask was last time, we had a kind of a conversation where Nikunj was also participating and asking questions,
Right.
etc. Is that the format this time, or what is it like?
No, this time Himanshu said maybe just Uma can speak and you can talk about certification. That's all. But I have requested Nikunj if he should be there on the back,
All
just
right. So, when will you be talking about the certifications? Right at the start, right?
I was thinking to once you finish, then
Once I finish. Okay.
yeah, and then
All right.
we'll talk about certification a bit, and then we can have some question answer sessions from the people.
Okay. I got it.
Yeah.
Yeah. So about 30 to 40 minutes I'll talk, and then I'll hand
Yes.
over to you for about 5
Yeah.
to 10 minutes. And then
Yes.
another 5 to 10 minutes for that question.
Right.
Okay.
Yeah.
I think half an hour should be good. Half an hour to 40
Yeah.
minutes. Should be good.
Yeah, because then conversation and that also takes time as well. So just 2 minutes and then we will be starting.
Yeah.
Yogita,
Yep.
should I start entering all?
I think so, yes.
Yeah, it's just 1 minute to 5:30. Good morning, Uma ma'am.
Oh, good morning.
This is Amit. I work with Yogita under for digital marketing.
Excellent. Excellent, Amit. Nice to know of you.
How are you, ma'am?
I'm good. I'm good.
Okay. This okay. You can start. Amit, you can start. Oh, okay. So people are already started coming. That's okay. Good evening, everyone. Can you guys hear me?
Yes, we
Yeah,
can.
you're audible.
Yes.
Audible.
Yes, ma'am.
Thank you. We're just waiting. I think people are just entering. Just give just 2 minutes and then we can start immediately.
Hi, Uma ji.
Oh, hello. Morning. Good evening.
Namaskar, Uma ji. Prakash Ranjan Sinha this side.
Hi. Good to hear from you, Prakash.
Yeah. I got a mail. I saw. I thought, if not face to face, see you face to face on the Zoom.
That's so nice of you.
Yeah.
That's nice of
So,
you. All good, Prakash?
Yes, ma'am. Absolutely. How are you?
I'm good. I'm good.
So you are in USA only, na?
Yes,
Yes, nice. My son has also moved to USA.
I see.
So he's gone for his master's studies,
Okay, where is he?
North Carolina State University.
All right, quite close to where we are. So if you come for graduation, milte hain fir.
No, post graduation, masters.
That's what, when he for his जब उसका finish होगा आप आएंगे ना?
Yes, yes, बिल्कुल आएंगे.
हाँ, तब मिलते हैं.
So nice of you. Thanks. It's a great opportunity to again listen to you. It's always been a pleasure. I mean, a lot of learning from you.
Nothing new to say, Prakash.
No,
I sometimes get.
I should not be. I mean, modest. When I definitely I can tell you, in my 32 years of journey, you are one of the person from whom I've learned a lot of things. और आपके कुछ चीजें मैं अपने ट्रेनिंग में मैं हमेशा बोलता हूँ.
Thank you.
So that's very good.
Yeah.
Thank you.
Thank you, Prakash. So good evening, everyone. I think it's the right time to start. I'm Yogita, and I welcome you all once again, and thank you for joining in today. As you know, this is our third webinar in Wealth Management series, and we are talking about portfolio construction, risks, and balancing risk and returns. Most of the people know Dr. Uma very well, but for those who are new or joining for the first time, I would like to briefly introduce Uma. So Uma holds a doctorate degree in finance and she's the reputed subject matter expert and trainer in the capitals market area. She was a professor at Indian Institute of Capital Markets, where she has trained a range of professionals, right from ministers, bureaucrats, regulators, fund managers, analysts, and many more, like investment advisors. And since then, she has worked in Prudential ICICI Mutual Fund as a vice president, and thereon she has founded 14 years back CIL, and since then she is guiding and spreading the awareness on the investment education and learning. So I would not take more time from here talking about Uma or CIL. I would like to hand over to Dr. Uma and take the podium from here.
Thank you, Yogita. Thank you. Good evening, everyone. It is a pleasure to be able to connect, thanks to technology, to be able to connect with all of you. A good part of my career has been spent traveling, talking to investment advisors and others across the country, and I'm grateful for that. And I do know that many of us here are familiar with all those early days of talking about equity markets and about returns and about risk. So in a sense, what I'm going to talk today is not so new. I mean, it's so well known, and these ideas are so well known. And this series, the series of talks that CL is organizing, is primarily to spotlight our certification program in wealth management. Because when we created this program, our intention was to be able to develop a cadre of investment advisors and professionals that advise investors about how to generate wealth or how to deal with their money, to go through some important principles in finance, which will help them in their task. Considering that these subjects are not taught formally in a university, or even if they are taught with a theoretical bent, our idea was to incorporate it into the certification program. Now, one of the core principles there is portfolio construction. In my view, it is the core job anyone who's dealing with an investor can do, and that is the place where an advisor is able to add value. So what we are going to talk about, obviously, I mean, those of you who know me will know that my presentation is not going to be filled with numbers and data and analysis. It is going to only talk about key principles. It's going to talk about certain issues that we face when we actually try to construct a portfolio. And of course, it's not going to talk about products or product selection. Okay, I'm not going to be, I do believe that that is another skill. Product selection is another skill. Um, but it's, as many of you will know, it's acquired over time. You know, there isn't a perfect way to select the best products for the investor's portfolio. We use various criteria to select, but since asset allocation and portfolio construction rules, you know, much bigger than actual product selection, in this session we'll talk about about portfolio construction. Let me share my screen and open up the presentation that I want to. Is it showing?
Yeah, it is showing. You just need to make it full screen.
I'm just trying to. Yeah. Is it better now?
Yes, Uma.
All right. Okay. So let's go ahead. Okay. Now, the first core idea in portfolio construction is this, that we cannot be managing for return and risk together. Many of us tend to get into a problem when we are trying to work for both, because we intuitively know that we have to look at both. But there is a way to structure the optimization problem, which is, I mean, how will we optimize? How will we generate the right kind of expectation in the minds of the investor? Now, very clearly, for a given level of return, we can manage such that the risk is minimized. Or is the important word, or. For a given level of risk, we can say what is the maximum return that can be generated. So it is not possible to be able to define. Many of the times when we're looking at, we're saying, oh, this one has a return of 14%, but it comes with a standard deviation of 30. Now, it won't make practical sense to be able to grapple with both. For example, if we are trying to look at a financial goal for the investor, most of the time, we know what is the financial goal that we want to pursue. We have made an estimate of the goal value. We have also come up with what is the amount of investment that the investor is able to make. As I will talk later, that's an important contributor to the way in which the portfolio will work. Okay, so many times we know that the investor contribution has its own constraints as well. Okay. So once we've defined it, we know what is the running rate for the goal, or in other words, what is the portfolio return that must be generated for reaching that particular goal. Now, most of the time, from practice, we know that we want to be able to keep this number conservative. The reason we want to keep this number conservative is because we worry about risk. We want to be able to say that, look, I don't want to use the past and say, oh, equity will give you 60. Now, I don't know whether that's really, and there is a cyclical idea. So if you're going through a boom period, your estimation of returns will be overstated, you know, because 20 will also look like a small number in a boom. But 10 will look like a very ambitious number if you're going through a down cycle in the markets. There won't be confidence to suggest a higher number. So with practice, we know that we want to be able to suggest arrive at a run rate which we believe is going to be realistic. Let's assume that that run rate has been fixed at, let's say, 12%, just for the sake of argument. Okay. Now, the whole portfolio construction problem is keeping this 12 the constant and reducing the risk for achieving this 12. That's how it should be defined. We can't go back and tinker with this 12. We have to begin with keeping one of it constant and then saying what will happen to the rest. Now, when this is the most commonly used approach in practice, solving for risk given return is the most commonly used approach. And many advisors spend their time in convincing the investor that this is the right approach to take. However, the investor will be on the other side of the optimization problem, where they will not be able to strictly define, but they will say that this is the risk I can take. What is the maximum return I can get? And we know that they can get a little unreasonable there, in the sense of saying that, this is the kind of risk I can bear, but I need to get a very high level of return. Okay. So when we say that that maximum return for a given level of risk, we want to be able to see, if we take that approach, we want to be able to see how are we going to define the level of risk. For instance, if you've done the risk profiler, or you have had a conversation with the investor says that I will not take any risk to the capital, for example. Okay, this is how the investor is defining it. So if that is the case, you're actually working with a standard deviation of 0, right? It's difficult to construct a portfolio. We all know that today, everything, including government bonds and bank deposits, are subject to risk. So being able to construct a portfolio of that kind is difficult. So if we are able to say that, look, the return range will be between 6 and 8 for your kind of expectation, or if this is the expectation you have, you might have to settle for a 5 to 6% level of return. You get what I mean? So even if the investor is talking about risk, your advice can only define it in terms of the return and the range of return. It is complicated to be able to manage a portfolio by saying that this is the maximum it will move, because you're talking about factors that you don't completely control, and factors that will, to a certain extent, be difficult to manage from an expectation perspective. It is not as if advisories do not practice on this. There are, for example, we are defining the risk at the lower end of the spectrum. For example, there are funds that will look at the higher end of the spectrum. The investor says, I am fine to take any amount of capital risk. I'm good with wiping off my capital. Just go ahead and choose the riskiest portfolios. Then you will find that these kind of managers are looking for very high risk opportunities, because their idea is to maximize the return, given the fact that the investor is willing to take, a very high level of risk, right? So this kind of a definition comes more in a product design or in an advisory design perspective, but we're mostly working with minimum return given level of risk. So it's important to not straddle both. Anchor at one and manage for the other is something that will work better. Now, once we have said that, and then we move to looking at the return. Now, there are many arguments which talk about, oh, but the investor is risk averse. No, but the investor is risk taking. I just bring in a little bit of theory here. There is nothing like risk-taking investor. And the way we want to, everybody is by definition risk averse. The degree of risk aversion differs, and I'll come to that point. Now, what do we mean when we say risk averse? Now, suppose an investor is given 2 choices. One in which there is 100% possibility that you will get a 6% return. And another in which there is a 50% possibility that your return will be 8%, and a 50% possibility that the return will be 4%. So this is a risky investment. It can swing between 4 and 8, okay? But it's average, as you notice, 50% probability of 8%, 50% probability of 4%, which means the average is 6. What would the investor choose? Every investor will choose risk-free 6. Virtually every investor will choose risk-free 6, because when you compare the two, there is no premium for the risk I'm taking. Okay, if I take this risk that the return can swing, I will expect the average to not be 6. The average needs to be a little over 6 for me to take that risk. Is that right? This behavior is what we call as risk aversion. Risk aversion means other things remaining the same, which means the return remaining the same. The same idea that we discussed in the previous slide. Return remaining the same, investors will choose a low risk option over a high risk option. That is what is risk aversion. Now, for this option with swinging returns to become better, what should it offer? It should offer what we call a risk premium. So if the return must swing, suppose you have an option which says 50% probability of 10% return, 50% probability of 8% return, you're looking at an average of 9, which means compared to the risk-free proposition, it offers a 3% premium, which is what we call the risk premium. So all our portfolio construction choices are based on this idea. So it's very important in practice to be able to look at your asset classes to ask, what is the risk-free? I mean, there's so much discussion about the risk-free rate. Now, risk-free rate is a rate that will be paid for money that will not be managed, but just be kept idle. For money to just lie. That's your risk-free rate. Okay. Any deployment of money will generate risk. So when we say this, that is the reason why we take the 3-month treasury bill rate. All right. And in some regimes, they will take the repo rate. They will say, this is the rate at which everyday money is moving in the system. And therefore, this is my risk-free rate, which means if you're looking at a 4% risk-free rate or a 3.5% risk-free rate, that is rate for money to just be there. All right. I'm not using it. I'm telling you, I'm not using it. So I'm just keeping it. So I want to be paid for not using the money. That's your risk-free rate. Okay. So when you're evaluating investments, you want to look at how much more than the risk-free rate is this investment offering, and therefore what is the risk premium. Now there is work on risk. Satyajit Das's work is one of the most well-known. Professor Damodaran of Stern University publishes risk premiums every year. Absolutely thorough work. Professor Verma was doing it in India, but we don't have an extensive database that an advisor can refer to. But considering that you're dealing with investment products and you have return history, you have a broad understanding of return history, you need to be able to look at where the risk premiums are lying. Is there a risk premium for this product over a period of time or not? If yes, this is a product that will have to get into my portfolio construction. And as a rule, higher the risk premium, greater will be the risk. So we know that equity, real estate are all higher on that scale, and bonds, etc., are lower on that scale, which brings us to asset class returns. Now, asset class return is the bread and butter of the portfolio construction business. Okay. So the problem we have in this discussion is that we are always talking about return and risk together, which is why I began with the optimization slide. Every asset class will have a certain level of average return, which it has achieved over a period of time, which is something which we use as the guide. So if we were to, how far we have to go and all of that. So if we have to say last 25 years of return and bring in a 16% return for equity, for example, okay. Now this number is going to be affected by what we know as cyclical factors, right? Cycles of how return has behaved. Now, it's only over a period of time of looking at these returns that we are able to say, okay, the amount of return that you should hope to get if you are going to be in equity is in the, you will say, I have looked at most planning documents. They'll say in the range of 12 to 16, and you'll always kind of understate it and you'll always kind of put it. Whereas from an advisory, for you to personally know, you should know where this number is likely to stand because it's core to your portfolio construction idea. And it's not about the number being absolutely right. The idea is for the number to enable you to do what we call as a risk return, creating a risk return matrix. Where does this stand in terms of premium? So we all know very clearly that small cap stocks will stand right up on the table. Venture capital, etc., will be higher. Small cap will stand up there, mid cap will stand next to it, large cap will stand below it. Risky debt will stand below that. A good quality debt will stand below that, and then you will have government debt, and then you will have short-term debt, and then you will have treasury, and then you'll have repo rate. This matrix is known to all of us, and this matrix is the basis for the kind of portfolio construction that we will do. And what we will focus on in our mind is to say, from this matrix, there are cycles in play. So if I say that equity return from my observation of history has been in the range of 14 to 16%, if I were to put that number, or even if I were to say that any allocation to this should generate a return of 15, let us say we put that number. If we put that number, we want to be aware of what we call as the cyclical and structural components, which is why we are always talking about long-term portfolios holding equity, because we have data which will show that cycles in the equity markets tend to get evened out over a longer period of time. When we're talking of structural components, when, for example, risky debt, we're talking of risky debt, we know how the credit crisis played out in the Indian markets, and we know how structurally the whole problem of collusion and of what do you say, malified misuse of other people's money has been a structural issue with the credit markets, which means that you want to understate, not only understate the returns, but be very careful in terms of how allocations to this asset class is going to happen in your investors' portfolio. So this is stating the obvious, but I thought that I will state this upfront. Holding the return metrics in your mind, being able to have an asset class classification for that portfolio, for that metrics, and being able to work with it. So your risk management, which is where I'm coming to, your risk management is about allocating to these buckets, keeping in mind the risk. It is not about saying, oh, this is 6 to 8, this is 10 to 15, this is 15 to 20, this is 4 to 6. No, because then your customer's portfolio will have so many possibilities. Now, you might think that it helps your risk management in terms of performance. But what will happen is, if the portfolio has done well, you will not be able to highlight it. You won't be able to own it, right? Portfolio construction is what you own as your contribution to the investor's wealth. So you need to be able to own it to say. So if you're saying that this is the levels that these asset classes will earn, then the way you're constructing and managing the portfolio will manage for the possibility that these returns can swing, right? Which is where we began. Now, let me just show you a simple return metrics, which is from Quantum, okay? This is March 2020 data. It hasn't been updated after that, but you can use any of these, this information that's available online. And if you see here, now this table is simply showing the return performance, year-on-year return performance for 3 asset classes: equity, gold, and bonds. Now, what has been used for bonds is the 10-year GSEC return, and domestic spot prices have been used for gold. Now, all of us who construct portfolios are very well aware that what we talk of averages is really something that, we know the risk. So what is the risk really means that average is one straight line and the actual return is running up and down that, okay? So if you look, and we also know that the same asset class is not going to perform well every year, which is what provides us the opportunity for portfolio construction. If you leave it to the investor is going to be just misled by these performances. And we know very well from experience that the investor will look for the immediately, last year equity did very well, so they'll expect equity to do well this year too. So if you notice here, every year that equity has done well, it has underperformed the next year, right? There is no pattern here. There is really no pattern here which says that if I use this table and if I were to arrive at a predictive outcome, if this happens, this will be true. No, you can see that this table has fairly randomly distributed numbers, and the same asset class is not on the top. There are years in which equity has done well. There are years in which bonds have done well. There are years in which gold has done well. And there are years when an asset class has done very well and then slipped down, right? Done very well and then slipped down, and then done very badly and gone up, okay? So there's the random table, which is exactly what gives us the opportunity for portfolio construction. So if you were looking at a portfolio that held all these 3 assets, not only will your portfolio have a much lower level of risk, but your portfolio will also be able to capture a level of return that is incommensurate with the investor's goal. See, that's really where we want to go. We do not want the investor to be swayed by the return swings in the market, but be able to progress towards the defined financial goal at a running rate that we have discussed with the investor. So it actually, this actually be the one line requirement for portfolio construction, which is the combination of assets will deliver a better return, not only for the investor, but also for the advisor. Now, if we were to, then the focus is really on risk. So if we were to look at risk management alone, so there is a run rate, and we're looking at how we are going to build a portfolio to meet that run rate, which means we are looking at a percentage allocation to risky assets like equity and debt, equity and gold, and we are also looking at percentage allocations to debt, long-term debt and short-term debt. Now, as I told you, we're looking at a range of asset classes, and we're looking to how to allocate to these assets. Now, let's say we're looking at all of them. So we are starting from small cap, mid cap, large cap, and then we're looking at, you probably want to add sector to it if you fancy that. And then you have risky debt, and then you have long-term GSEC, then you have short-term GSEC, and then you have very short-term debt, and then you have treasury bills, and then you have savings bank. Okay, so repo or the savings bank. So you're looking at this whole range of assets. Now, the principles, these are 4 principles to remember in portfolio construction. The first principle is precious. It's a precious principle. The risk of the portfolio is not the average of the components. It never is. It will be, see, when you say return of the portfolio, you will say how much is there in one asset class, how much is the return and average. So you'll do a sum product. Okay. You will say what is the weightage, what is the return, and what is the average. You can't do that to risk. You can't do that with standard deviation, which is the most beautiful part of portfolio construction, because since portfolio risk is not the weighted average, but it is weighted average adjusted for what we know as correlation between asset classes. So imagine a straight line and imagine a wavy line that's going along it. So straight line is the average. The risk is this wavy movement around it. Now, what gives us the huge benefit of portfolio construction is one asset class can be doing well and therefore risky, above the average, while the other asset class is doing bad and below the line and therefore highly risky. In the investor's mind, both are risk, right? Both are away from the average. The probability that 2 asset classes can move differently means that they're not correlated. They're not running together. They're moving in opposite directions, which means when you bring them together in a portfolio, the risk of the portfolio is always lower than the risk of the components. So when you're managing for minimizing risk, your tool is to be able to bring those asset classes together, which will offer a lower level of correlation. We're going to talk a little bit about this in the next slide. So it's always, unless everything is running together. Now, when does everything run together? I mean, that's the unfortunate problem in portfolio construction. There are so many nuances to the correlation. Now you have a situation where there's a crisis in the market. That's when you need the benefit, right? You're saying, oh, things are falling. What is going up? If there's a crisis, everything will fall together. So the downside correlation can be higher than the upside correlation. So you might lose the benefit when you actually need it the most, but that's more an event risk. You really can't control or manage for it. And it will change. So you will find a period of panic when everything is looking bad, but recovery will happen soon enough, as we've seen in the COVID situation as well. Recovery will happen soon enough and asset classes will begin to turn around and perform. So as long as everything is not moving together, constructing a portfolio will offer a much lower level of return, or a lower level of risk for the same level of return. In fact, if an investor has an all debt portfolio and you added equity to it, the investor will enjoy a period, let's say for about 20% equity. The risk will be lower and the return will be higher. It's a beautiful proposition in portfolio construction. And it's important for you to be able to take this to the investor. The investors are not aware of such possibilities. So a portfolio that brings various asset classes together will exhibit a lower level of risk for the same level of return, which is why we call diversification the free lunch. Yeah. Now, therefore, that brings us to the core idea in portfolio construction, which is a very intimate knowledge of correlation matrices or how correlations work. Now, these are available online. There are various computations that are there. You can make your own computation. Now, if you looked at this table, I did say that I won't have too many numbers, but these are the only two. Okay. These are the only two core ideas. If you looked at this table, all this table is showing is now there's one which you see is correlation with itself. So you have a BSE 200 and a BSE 200. The correlation of it is going to be 1. Now you look at mid cap, yeah, 0.96. Sorry. Yeah, there's 0.96, right? Now 0.96, and look at Sensex and the 200 and the small cap 0.86. So what is the important takeaway here? Equity as an asset class is moving together. So if you're looking at small cap, mid cap, large cap, as components to diversify from a main index, you're not achieving much. So if you build a portfolio in which you're saying, I am giving you 60% equity, but of the 60% equity, I am doing 20%, 40% large cap, but in the interest of diversification and benefit, I'm giving you 10% mid cap and 10% small cap. You're not going to achieve a much higher level of a return or a dramatic modification in risk. Okay, you have to deal with this a little carefully, which is our idea was that adding these is going to is going to increase the risk of the portfolio substantially. Data doesn't bear that out. What the data bears out is just this, that these components tend to move together. It offers an immense opportunity. If there is going to be, now we were talking about risk premiums, right? If there is going to be a premium to being in, we know very well, I mean, this is the idea of construction. We know very well that when you're looking at narrower indices like the Sensex or the Nifty, we know that they're weighted in sectors. We know the source of this risk, right? We know that they're weighted in sectors which may or may not perform very well. For example, a heavy weightage on oil, a heavy weightage on banking stocks, for instance, or some weightages to chemicals, fertilizers, so on and so forth. But if you were to look at mid-cap and small-cap portfolios, you know that these portfolios do not hold, for instance, PSU stocks in a large extent, okay? And the whole idea is, it is going to be very risky to get into mid-cap and large cap, because mid-cap and small cap, because mid-cap and small cap will offer a very high level of business risks, etc. But if you looked at it purely from a risk management perspective, fairly similar to the larger index. And if there is a premium to it, the upside capture in being able to use these portfolios is higher than the downside risks that may be achieved by, what should I say, changes in the return over a period of time, which means that including small cap and mid cap in a portfolio construction is going to offer you the benefits of what we spoke in the first slide, which is being able to achieve a better level of return, but keeping the risks lower. Because the correlations, as I said, if correlation is 1, they're all pretty much together. Okay, so which is also the reason why indexing is not very popular in many markets, because the index and many components of equity, many large equity portfolios tend to enjoy a much higher level of correlation. It's a very characteristic feature of the equity market. Where the risk to the investor will come in is when you include sectors. If you looked at sectors, I don't have the data here. If you, for example, used a sector index here, okay, its correlation with the broad indices will be lower than what I'm showing here. Now that's a double-edged sword. What does that indicate? Now those are the tactical components of your portfolio. Suppose you were looking at a sector like IT or a sector like FMCG. FMCG is classic. FMCG will show very low correlations with, it won't be in the 80s, it'll be in the 60s. So low correlation with the broad index. So when you are looking at, let's say, a fund that is specializing on in a particular sector, right? The lower correlation means including this sector into the portfolio will offer a certain amount of downside protection, because if most of the market falls, this sector historically does not fall as much as the market does. So it does offer a correlation benefit. But you must keep a cyclical component in mind, which is in terms of saying whether this inclusion of this sector is adding is adding to the risk in a manner that commensurate returns are not higher. Okay, now it's a difficult call. So unless you have your following sectors, unless you are, because the extent of cyclicality in sectors will be much higher. See, when you're looking at an index or you're looking at a broader portfolio of mid cap or a small cap, you're not too worried about what's going on with the components because there's a balancing, averaging factor at play. The moment you move to sectors, those balancing factors, inherent balancing factors are not present, but they do offer a diversification benefit. Now, if we move down and looked at gold, gold is the classic example. You look at the gold's negative returns. So much as we may have negative correlations, I didn't say negative returns, I'm sorry, negative correlations. Much as we do not like gold from a financial asset perspective, its precious inclusion in the portfolio comes from this quality. So if you're looking at portfolio construction, and if you're looking at being able to keep the return risk lower for a given level of return, without including gold in that portfolio, you will lose precious opportunity to bring the risk down. Because that's gold's biggest attraction, its ability to have a negative correlation across asset classes, which means investor understands the product, and from a construction perspective, it offers a precious risk reduction opportunity. Okay, and the same is true for the bonds. Now, there are many people who will say, oh, I am a risk taker and I will want to have, I can go up to 80% in equity. I can go up to 70% in equity. Fair enough. The problem is that the risk reduction possibility that is offered by including bonds is completely lost in this portfolio, which means this portfolio is going to swing up and down as the equity market swings. And all of us who've been in equity know how strong and severe those swings can be. So there are people who will say, oh, but I will book profits. What will you do with the book profits? You will put it in the bank, right? So what are you doing? You're rebalancing your portfolio and you're allocating to debt. You could have allocated right at the start instead of trying to time the market. So the allocation to debt is the risk buffer. The allocation to debt is the buffer that is available for managing the risk that is present in equity. So if we are looking, which is what we classically say, we would say that a 60-30-10, which many of us use for an investor with a higher risk appetite, a 60 in equity, a 30 in debt, and a 10 in gold, is a fairly, what do you say, mostly loved portfolio combination. All that we are trying to do is to manage this equity down and take this debt up for an investor with a lower level of risk. So beginning with this combination and then moving it for the purposes of investors, depending on their return risk part. Keeping the correlation in mind from a risk management perspective is critical and very important. So those three are the components in portfolio construction: your asset class returns, your asset class performance, and asset class correlation. If these three are present, you are able to see, or you're able to expect, you can mathematically bring these together and put it as the expectation for yourself in terms of where the return will be, how much the return is likely to swing, and how much the risk is likely to be lower. So the performance of your portfolio, this is something that I've been urging advisors again and again. Instead of showing investors tables, instead of showing investors return numbers, please draw a picture. Please draw a picture which tracks the asset classes and your portfolio and demonstrate to the investor that your portfolio is running at a pace that we have agreed it should run. It'll do less than the top performing asset class, but it'll do better than the lower asset classes. So the portfolio is running at the required run rate and is doing so without fluctuating too much. That's really the crux of portfolio construction. Let me close by adding a few ideas here, right? Now, If you're adding assets to reduce risk, please bear in mind that the more and more you add, the more and more the return will look like average. Okay. So when you add assets to reduce risk, keep this in mind. Keep in mind that, every time a product is positioned as, oh, it is a diversification opportunity, and you put, 2% in international, in global assets, you're not going to be, doing anything much to the risk. Okay. So when you're adding assets, one, the weightage to the assets, as we said, weightage to the asset has to be substantial for it to make a difference. And the correlation should matter for it to actually reduce risk. Otherwise, it will just be a dummy piece in your portfolio. Your allocation should manage return, as I said. That's the most practical way to construct a portfolio. Your allocation should focus at all times for achieving a return that the investor requires, the run rate, as I said. If you're doing better than what was expected, you're doing very well. The investor is very happy. Okay. Allocating to manage return, the large cap, mid cap example that I gave to you. So your focus is on choosing those asset classes. Your eye is on where the correlations are. Unless there is substantial weightage to an asset class, you will not generate an alpha. So there won't be a risk premium which has been generated unless the weighting is substantial. Now, there are portfolio management schemes, or there are investors with ESOPs who are holding too much of a particular asset. Okay. Now, we know that too much to that asset is generating an alpha, or is generating a better return, but we have a correlation in our mind, and we know that the amount of risk that is associated with it might be higher. So please make sure that weightage is not too low that it won't matter, or too high that it will bring in more risk and make your portfolio risky. There is no shortcut to managing downside risks. However, we construct the portfolio based on past returns. We know, as I was explaining to you about the debt markets and equity returns, you want to be able to have an allocation to debt markets, not because you don't like equity or you are taking a call, but because you want to manage the downside risks in equity, and there is no way you can do it unless you have debt and gold in your portfolio. And the last thing which we know very well is that there are event risks. The whole bad debt problem in the debt markets has made the credit markets so risky at this point of time, right? There are governments that are failing. There are government bonds that are defaulting. So not in India, fortunately, but there are large event risks, COVID, as we know. So there are larger risks that cannot be managed within this framework, and this is part of the problem that comes in. Okay, part of the game. We can't do anything about it. Okay, and this is the last slide. Last pitfalls. When you've constructed a portfolio for the investor, you have taken into account the asset class returns and the correlations, and you have made an allocation based on the run rate required for the portfolio. That's really the crux of the job. But while you're doing it, there are three things to look for. One, too many things is going to give you average returns. There are so many investors. I know of so many people who come and talk about stocks that they've picked up. Oh, I hold this stock, I hold that stock. I track this person for about a year. He has mentioned at least 30 names. I can give it to you in writing that he's not outperforming the index. It'll average out. It's very important to keep these investment principles in mind. You will look like an index if you keep adding more and more and more. Okay. So do not make the portfolio complicated and have too many components. It will give average returns. Okay. Then reactionary tactics to a portfolio. It's a big problem where, the equity market is looking so heated up. So you must book some profits and keep it in debt. And once you have done it, the market is continuing to run and the investor is very unhappy about it. So looking at what's happening in the market and, the market is looking very bad. Now you have to withdraw the money and, you have to go somewhere else. And then after you've withdrawn, the market is going up. So our asset allocation idea, or when we talk of strategic asset allocation, we're trying to say that we are going with long-term return performances in the portfolio, and therefore we would keep it unless we believe, and if we make changes. What I say, when you do a rebalance, when you do meddling, when you change, you might move the 60 to 55. You might take the 40 to 45. but don't take the 60 to 20 and the 40 to 0. You create huge risks in the portfolio, huge performance problems in the portfolio. Asset allocation is a one-time game. Portfolio construction is a one-time game, based on your sound, solid understanding of how asset classes work and what the investor needs. I have mentioned this several times. There's nobody other than the advisor who can do this. No one playing this role. There's no one playing this role. So it's only the advisor who can step in, look at the investor on one side, look at the asset classes on the other side, and bring them together, right? Simple constructions, you do 50-50, you do 60-30-40, you have your favorite combinations, come up with any of those, but only you can do it. All these combinations will have to deliver return, which is the run rate, and these combinations must take into account the asset class correlations so that the risk is minimized. So that's really where we are. I think we've spoken about this, so I'll take a minute. We all know that we are in a situation where quality matters. Okay, so please don't choose substandard products of any kind. Try your level best to diligence what you're choosing so that quality is there. Make sure that you're consistent in what you're doing. You know that past performance is a rear view mirror. It's always something that we didn't anticipate that is likely to happen. We all learn to manage that. And there is nothing like a risk-free portfolio. We can only manage for it. We can mitigate it, but we can't eliminate risks. So that's where we are. And I would, there is a huge benefit that the advisor has, which is what we call the overfunding problem. So even if you had a target for the goal and a conservative saving plan, the investor, as he goes along, will contribute more and more to the portfolio. So at some point, the portfolio's performance, you don't know how much is coming from the return and how much is coming from the investor enthusiastically contributing to his goal. So please remember that both will have to run together, and investor contributing to the return works in the favor of the advisor. So many times we have run rates which are so low, 9%, 10%. The investor still achieves the goal because the investor is contributing a lot to the portfolio. It works to your advantage. Make sure that it's working and focus on the risk. That's the primary job. So end of it, I think I've taken, I was supposed to take 40 minutes, but I'm at 45. I'm hoping that I'm still doing all right. So I'll stop share and come back to questions. Yeah. Yogita, I'm open to questions that people may ask. The chat window is full of questions already.
Yeah.
Uma, Yogita has a small, quick
Yes.
2-3 slides on wealth,
Yes.
so that, and then
Yes.
we can take the questions.
Yes, Himanshu.
Is that okay?
Yes, I'm
Yeah.
handing over to Yogita
Yeah,
because it's the right time to talk about the sales wealth management program.
Yes.
Over to you,
Noted,
Yogita.
noted.
Yeah. Thank you, Uma, for giving us the good insights and great insights on portfolio construction. And I'm here with the CIL offering on the certification. Can you see my slide clearly?
Yes. Can you?
Yes.
Yeah.
Yes, it is visible.
Okay, thank you. So as we all know, that CIL is there for last 14 years and have trained more than 3 lakh professionals across the 150 corporates. And we have trained almost 17,000, more than 17,000 learners on the wealth management certifications. So our both certification, wealth management basic and advanced, we have 2 different levels. One is a foundation course and the one is the advanced for the actually technical applications of the concepts. So wealth management basic and advanced both are accredited by NISM, and we call it a pathway to do a registered investment advisor. So if you would like to become a registered investment advisor, both of this valid certification will help you take there. So let me give you a little bit more description on the basic course. So as I said, the wealth management basic certification will give you the entitle of accredited wealth planner once you complete the course. And the advanced certification will give you the title of certified private wealth manager. So this definitely looks good on your resume or for the upskilling. Then further to that, the both of these courses are available online. So you can do it as a self-paced online course, or you can have a blended approach where you have a 10 to 11 virtual trainer sessions, of course, virtual in today's scenario. And we do start with a diagnostic test, which is basically to check your functional behavioral skills on the wealth management course. And then we have some pre-read, when we say pre-read modules, some of the interactive online courses before the virtual session starts. Then we have a practice test and a final assessment, and then you get the certificate. So all this courses are available directly after registering on the website. Wealth management basic certification is the duration, we call it as around 42 hours, which includes the your self-paced learning as well as the 20 hours for the topics. Like we cover at least 10 sessions, 10 topics in the basic certification, which we call as a foundation for it develops your strong foundation for the investment concepts, capital markets, key asset classes, product. And then of course it is the great for the candidates who are graduating and who are entering into the wealth management advisory field. And it can be, you know, kind of adding multiple product to your single product selling. As I already mentioned that we start with diagnostic test. We have an online study plan on our learn management system. We have interactive case studies, quizzes, videos. Then we have a virtual session, and then you can have a online proctor exams at the NSCIT center, or you can have it on the CILMS as well. So this is about the basic course. At the same time, once you finish the basic, you would want to upskill and go further with the advanced course, which is basically the technical knowledge of macroeconomic cycles, market dynamics, risk return trade-off, and asset allocation in you know, which is critical for the private wealth manager. Again, it is focused on the professional portfolio construction for clients, which we have discussed today as in detail. So it is a more of an application orientation of these concepts to make it relevant. It covers the same flow with having at least 11 topics in the advanced certification. So both of the certification is available, and the duration, it does have a duration of a exam for 1 hour for the basic certification, and the advanced is 2 hours of 2 hours of exam, which is soon going to be you know, change to a because of the NISM you know, changes on the course. It is getting upgraded, and it is also going to have a 3 hours of exam in next month. So it is a good opportunity to start now if you are willing to start with this basic or advanced course. We do have this offering for the individuals or for the corporates as a you know, the courses. And other than that, the basic course, I would really like to mention the fee of the course, because multiple times people have asked, and we have tried to send it in through the email. But the basic course cost you 6,500, and the advanced course cost you 13,000. So do you have any question from here? That's all about the basic and advanced certification course. Do you have any specific questions which you would like to ask about the certification? Okay, I think I see some questions in the, yes, these are all qualification needed. Yes, Stephen, the qualification is definitely needed. So I think Himanshu, I have talked about the course, and I think we can open up the question answer sessions for Uma if no one
Yeah,
is
yeah,
having any questions. Yeah.
yeah, absolutely.
Yes. So guys, you can raise your hand and you can just start asking the question directly to Dr. Uma. There's a question called, is CFP certification is also required? So these are two different things. And Uma, as I mentioned previously, also many people have this question. So how do you like to reply that?
They're two different courses. I don't think we should. CFP is, as I said, CFP is primarily looking at the investor and financial goals, whereas wealth management is looking at portfolio construction, asset allocation, portfolio management and monitoring. So they're two different courses.
Right. So
Uma, there is this question from Amit Metkar. It's more contextual now, which is saying is 6 months or 1 year down the line, it will be difficult to sustain these valuations. How to balance portfolios in such situations? You did answer, but you may want to just add up to this thing.
Changes to market valuations, PE, for example, is a cyclical factor. You just take it in your stride when you allocate portfolios. You won't really act for it. So there's nothing to do. There's nothing to do about it. As long as your portfolio has a debt allocation, you're going to be, what is our worry about high valuations? That it will get corrected, right? As long as the portfolio has allocations to debt, that'll be taken care of. So no action required for changes in valuation and portfolio construction.
Sure, thanks.
Right.
Stephen, your question on qualification required, you need to be a graduate. Typically we suggest for the advanced certification, someone should have a experience of over 3 to 5 years at least practical experience. Else, I think you should, obviously, if you do not have that experience, you are a graduate, you can start with the basic certification, which is there.
Right.
Anyone else who, if you want to unmute yourself and ask Uma, that is also fine, which is there.
So there's a question from R Singh. He's mentioning, can we call ourselves as advisor after passing the certificate?
Yeah, so if you apply, advisor, as you all know, one needs to apply to SEBI to become a registered investment advisor. The wealth management advanced certificate course is approved under the SEBI investor advisor guidelines. So once you do that, you have the necessary qualification, educational qualification. However, you will have to apply to SEBI with that certificate so as to call you as a registered investment advisor. There are other criteria along with the educational qualification which you need to fulfill if you want to become an RIA.
Right. This question from Prime Financial, what's your view about the penetration of direct plan and fintechs, and do we need to start focus on RIA model?
I would say, obviously RIA, I don't know, Uma, you were smiling, you have a view, I can talk on all of that. You're on mute. Uma, you're on mute. Sorry. Uma, can you hear us? You're on mute.
Sorry, this is a problem with Zoom. I was just saying that a much debated topic. You'll see, it's not within the scope of the session or the time we have to discuss that question. I'm so sorry, Prime. I think I have to skip that question.
Sure.
Right. For the basic level, is the final test is objective or descriptive? So it's
go ahead.
So it's a combination of multiple choice questions. It's a combination of multiple choice question and few of the descriptive questions as well. So we do have generally the practice test before the exam that will prepare you well for the final test. Uh, yeah.
Do
Any
we have
tools?
any
Yeah.
other questions?
Yeah, there's a question, any tools provided in the course? So
So,
what kind of tools are you speaking about?
so there
Uma,
was
you again on mute.
Have I have the yard guy here, so soon there'll be a buzz of the lawnmower. So that's the reason I. Okay, sorry. So, Yogita, I missed that question. I'm sorry.
No, there's a question, what tools are up? Any tools are provided in the course? So I was just asking what specific.
All the examples and conceptual understanding provided in the course are
Yeah.
its course is filled with inputs that are required for an advisor to add value to the investor. So they're all there. So there aren't, if you're asking for plug and play tools, we don't have them.
But there are
Yeah.
calculators, there are other things which you can use.
Yeah, they're everything available. Yeah.
Available. So there is one question on whether we say CFP can do the advanced course directly. You can do the advanced course directly. However, if you want to apply for becoming an RIA, then you will have to complete, at least take the basic test
Yes.
as well.
Yeah.
So otherwise you can do directly advance and get your CPWM certification. So Amit, most of the trainers for these courses are practitioners who have spent considerable amount of time, on an average about 15 to 20 years in this industry, and are passionate about education. Most of them are from the wealth industry and have spent enough time. Maybe we can, I think there is a huge list, Rohit, and we can share with you if you have any specific this thing.
This question from Sesh is, how do we evaluate pure equity at current market value or past 6 months value?
It was a direct question and I have answered it in the chat window itself.
Right.
All equity returns are evaluated with the index. Okay, so your own portfolio returns are available for you to measure. So you are benchmarking with the index and measuring yours and comparing. It's as simple as that.
Yeah.
So Amit, this certification is recognized by SEBI. We did answer this question earlier. Again, for the benefit of other learners, this is approved under the SEBI Investor Advisor Regulations 7.2. So you can go on to the NISM website or this thing, you will get the details of that as well. There is Ayazuddin Uma, who has asked this question. Can you let us know about stock portfolio construct, in particular, ideal number of stocks in a portfolio and their weightage, allocation percentage to various market caps or sectors?
I was just answering that question because it was a direct message. I was just typing the answer. But to just talk about it, look, stocks and portfolio is the fund manager's job. So that's not something that an advisor is seeking to do. Okay. Including stocks or building a portfolio. Based on the similar construct, the fund manager will also look for generating alpha, will also look for diversifying risks, and will also look for focusing on returns. The difference is he won't be looking at an absolute return. That's the differentiator only an advisor brings. The fund manager will only provide relative returns. Compared to the benchmark, I have done better. That's all he can provide. That's not enough for funding a financial goal. Funding a financial goal requires a specific run rate, and you have to target an absolute level of return. So as an advisor, you are not focusing on stocks. It's a fairly wasteful exercise to do it, because it calls for a different level of skills and a different and higher level of involvement. So I would suggest leave the stock selection to the fund manager or the portfolio manager. Choose the funds based on their performance and their quality for inclusion in the investor's portfolio. And construction is what we have spoken about. So I don't think discussing how many stocks, which sectors is in the scope of what I'm trying to talk here. I'm sorry about it, but that's what it is.
There is one question about the he's asking about the validity of this course. So basically, the basic certification is valid for 3 years, and the advanced is valid for one. Once you've finished your validation, you can renew it by giving the exam again at the CIL website. So you can just after finishing 3 years, you can always go on our website and register for the exam, and you can revalidate it.
There is a question on what is the overall return one should look at. As I was saying, the return that on its components, right? So there is no uniform return. Depending on how much you're allocating to equity, debt, and other asset classes, your return will get generated. It's just a weighted average. Okay, so there is no standard. So when your investor has a goal, and if your investor has a certain saving rate, the rate at which that portfolio should grow is the return that you have to target. And you're constructing a matching portfolio that will deliver that return. So there is no one uniform level of return that everybody should generate. There's no such number. That number will change depending on how much you've given to various asset classes. It can be anything from 8% to 16%. It can be anything.
Right. This this is a question. Can we directly appear for the test without going to the course? And what's the cost for the SEM? So Himanshu, would you like to answer that question?
Sorry, the answer is no. You will have to take this thing. Once you do it during the renewal, you can do it without taking the course. Renewal, you can just take the test, but otherwise you can't take the test without going through the course. Okay, Uma, there are a few questions for you.
So Nishant,
one is, do you think REIT funds to portfolio, adding REITs to the portfolio is a better asset allocation? One is in terms of your view on shrinking alpha, specifically with respect to which portfolio will rule the industry globally and emerging markets like India.
I think I've answered those questions in the chat window. Yeah, see, we are investing out of India, so therefore the benefits of the emerging market portfolio is available to us. India is an emerging market, and even sitting in the US, I can say that if I tell any of my friends any 2-digit return number, if I say 10%, 12%, they're all very amazed, because the interest rate, we just bought a house and the interest rate we paid was 2.5%. Okay, so this is a different market altogether. So your 4% is a good return, 6% is, oh my God, fantastic return. So we are already in an emerging market like India, in which the returns are double digit, the returns are good, and opportunities for growth are much better. So that's a beautiful thing. So that diversification benefit is available to us already. Others have to struggle to access Indian market. It's already available to us.
Anything on REITs, Uma?
I think the product is still very experimental. I mean, I think I answered that question earlier too. We do have quality issues in the Indian real estate market, you know. So there are quality issues that we are still grappling with. So it still holds uncontrolled, undefined risks. So we'll wait for the product to. We have to wait for the market and the product to evolve before we look for large scale. It's still a niche product for investors willing to take risk. It's still not a product that is developed to a level where everybody can participate. It's not there still.
So there is this question from Suneet. Suneet, you can take the advance certification. As we said that we suggest that people who have an experience of 3 to 5 years should ideally take the advanced certification. However, there is no hard rule. If you are a life and GI agent, you have cleared the IMFD exam, and you are confident, you have in terms of your experience with dealing with customers and portfolios, you can take the advanced certification. Rohit, we are not, as Uma said earlier, I think the seminar is on portfolio construction. We are not taking questions on direct plans and technology, which is, disrupting the industry.
Sorry, we're not doing it. Yeah.
Yeah. For certification, the material provided is in the form. So it is all the material provided is in form of predominantly interactive content, which is available on CIL LMS. It has case studies and other things which are all available on the LMS. This thing, there is no recorded sessions right now. These are for blended programs. We prefer live sessions of trainers for the same. So, and hence every program, the blended program is supported by about 10 to 11 live trainer-led sessions.
We do have some ebook e-workbook available, but it's as Himanshu mentioned, it's more of an interactive on interactive resources. Right.
Okay, so I think we have extended our limit. So
yes.
if the questions are done, then we can close it, and maybe you want to give the closing remarks, Yogita, and thank.
Yeah, again, thank you, Dr. Uma, for a wonderful session. And as I have mentioned you personally as well, people would like to hear you again and again, and we definitely would want to come back again next month with a new topic. This time we did ask people what topic they would want to discuss on. So I'll definitely pass on those remarks from the people. And thank you everyone to be very nice and graceful participants in the webinar today. And we definitely will send you the recording as well as the certification details to your email tomorrow. And if you have any further questions, please visit to our website, cil.co.in, or you might want to send an email to us at info@cil.co.in. So yeah, you definitely will get us the emails from us as well as the WhatsApp or SMS. Thank you, everyone.
Thank you, Ma, and thank you, everyone.
Thank you, everyone. It was good to be here. Thank you. Bye.